I thought I'd take a few minutes just to frame our discussion tonight, talk a little bit about the gold sector. I am an advocate for the gold price. I'm an advocate for the gold sector as well, advocate for the company, but also hopefully frame the discussion we're going to have a little later on with trade winds, talk a little bit about our strategy and vision and where the industry finds itself today, because I think that is valuable perspective as you consider investing back into gold equities. And we are starting to see some generalist interest back in the sector, particularly with valuations extended in the general equity markets. This sector is looking very value-oriented, and that's the opportunity. And let me talk a little bit about the gold price for a moment. You would think with interest rates going up and gold being the financial instrument it is, that would be actually bearish for the gold price. But if you look over many decades, historical trends have demonstrated that at the beginning of a nominal tightening cycle, gold price does exceptionally well. In fact, on average, we see gold rallies of 80 to 100%. Well, arguably, this tightening cycle started about 2 years ago, at the beginning of 2016, when gold was about $1,050 per ounce, and we saw the Federal Reserve start to introduce tentatively some interest rate rises, and we've seen about a 20 to 25% appreciation in the gold price. So what this tells you, and I'm going to stick my neck out, if historical trends hold in this rally, we could see gold at $2,000 an ounce by the end of this point. But what I would say is the industry is really not equipped to provide the leverage proposition that investors are looking for, because over the last 5 years, we've seen global gold reserves decline by about a third. Because when gold rallied to $1,900 an ounce, the sector saw massive cost inflation. We were in the midst of what we thought was a super cycle that would continue in perpetuity. We saw base metal companies add new capacity. We saw gold companies add significant new capacity. And there was quite a bit of competition for strained resources, human and otherwise, and we saw vast cost inflation, and we undermined the leverage proposition that investors are looking for in that type of gold rally. So investors rightfully demanded that we contain our costs, and I think we've done an exceptional job as an industry doing that, bringing our discretionary costs down. But one of the things we sacrificed was exploration. And as a result, we have not redeployed capital back into finding new deposits to replace what we're depleting. So yes, reserves have declined, and you might think it's because we're using lower gold price assumptions to calculate those reserves, but in fact, 70% of the decline in reserves is simply from depletion of ounces in the ground and not replacing them through our exploration efforts. Well, when that happens, inevitably production has to decline. And arguably, production has peaked, mine production peaked last year, and we're starting to see a gentle decline in production. And given the lead time to bring new production on, typically 10 to 20 years, there's a remarkable inelasticity of supply to price. We're not going to see that dynamic turn around anytime soon. We're forecasting supply declines for at least the next decade in the gold sector. So it's difficult for us as an industry to provide leverage to the gold price if we're not volumetrically increasing our exposure to gold on a per share basis. And as the peak of the cycle demonstrated a collective lunacy in the mining business when we were all building new capacity at once, I would argue we're experiencing collective lunacy at the bottom of the cycle right now with very little new capacity being developed in either base or precious. Obviously, what that does is amplify the peaks and the troughs in the metal prices. So there may be an overreaction on the upside. 2,000 may be a conservative estimation of where the gold price ultimately ends up in this cycle, given the lack of supply response we've seen in the sector up to this point. That's exciting. And what it does tell you, though, is gold companies are going to continue to shrink. Senior gold companies are going to continue to shrink. And we're arguing that the optimum production level for a senior company is no more than 3 to 4 million ounces. We're growing into that. We've been counter-cyclical in our thinking. We've done some judicious M&A. We've sold some things that are non-core. We've bought some things that have the potential to be meaningful in our portfolio. And we're growing our production base out over the next 4 or 5 years. The rest of the industry is shrinking to what we would argue is this equilibrium level of production. If you buy into that thesis that senior companies really can't sustain any more than 3 to 4 million ounces of production on a sustainable basis, we would further argue that you'd want to do that from as few assets as possible. If it's not a quantity proposition, it has to be a quality one. And by focusing on 6 to 8 geological districts to support that 3 to 4 million ounce production profile, simple arithmetic tells you we should be getting 400,000 to 500,000 ounces per district. That's chunky production. That means we'll get economies of scale. That means we're likely to have the lowest quartile in terms of all-in sustaining costs across our portfolio in the world. In fact, over the last couple of years, as we introduced our efficiency program, we've actually become the lowest cost senior producer in the world by focusing on assets of scale and by driving efficiencies out of the system. And there's still a lot of opportunity, we think, to deliver efficiencies within the sector, even though we've seen some of our competitors' costs start to inflect and their costs start to go up. But we do see opportunity for driving costs out of the system. Very focused then in terms of scalable assets of scale that drive those economies of scale, focused in the Americas, in regulatory environments that are used to mining, in low geopolitical risk jurisdictions. We're driving our costs to $700 an ounce, all-in sustaining costs, from $850 an ounce when we launched this journey a couple of years ago to improve the quality of our portfolio. And we're driving ourselves towards zero debt over the next few years as we're preparing the next generation of large-scale projects that we're bringing through the feasibility stage right now to perpetuate our growth beyond 2021. So 2 years ago, when I joined the company, we launched what we called the 20-20-20 program, which effectively would see us increase our production by 20% over the next 5 years, decrease our operating costs, all-in sustaining costs by 20%, while growing our reserves by 20%. Really, again, what's driving that is focusing on the quality of the portfolio, focusing on assets of scale, being disciplined in our exploration around our existing industrial complexes to at least extend the mine lives. But by having geological success within our established districts, that affords us opportunities for brownfield expansions, which through economies of scale drives down our all-in sustaining costs further. We also launched a program to drive $250 million as sustainable efficiencies at our business 2 years ago, and we've delivered on that. And in fact, we're going to extend that program up by 2 years and up the target. So please watch for our Q2 press release in July when we make that announcement. What's really ambitious about this 20-20-20 program is growing our reserves. In 28 years in the business, I've never seen a mining company put out a target for reserve growth. But we have such confidence in the portfolio of assets that we've assembled, the geological endowment we have within our existing industrial complexes, that we're confident that we can grow our reserves by 10 million ounces, from 50 to 60 million ounces over the next few years. In fact, we're a third of the way there in our first year of exploration, focused on achieving that objective. When you take these objectives holistically, what it means is it could add $4 to $5 billion to the net asset value of the business over the next 5 years. That's almost $5 to $6 per share. Consensus NAV on the street in Goldcorp right now is around $12 a share. It's meaningful growth in the underlying value of our business. And because we're so well capitalized, because we're driving down to zero debt, the per share value proposition over that period is immense. And that's what we're delivering, is value over volume. So I talked about this earlier on. We're driving towards achieving that objective of $250 million. We have, in fact, achieved it. And again, we expect to extend that program and up the target in July when we report our Q2 results. And people have asked me, have costs inflected? That's the recurring theme I've heard, whether it's at the BMO conference in February, the BAMO conference in Miami, also in May. Our costs starting to go up. And certainly, the commoditized elements of our input costs are starting to show some pressure, whether it's energy, whether it's local currencies. But I do say that there's a scope for driving efficiencies out of our business, particularly on the labor side. And we are, this year, launching and commercializing 4 significant technologies which would drive labor intensity and costs out of the system. The Watson data platform is being used in partnership with IBM to more quickly and more efficiently generate targets, exploration targets within our Red Lake district, where we have almost 80 years of exploration data we've just recently digitized, and using that to predict the next high-grade target in that district. Waste to ore is allowing us to convert waste stockpiles into economic ore by segregating waste from the low-grade material and bringing that above the economic cutoff and feeding that through our mills. So it's effectively turning sterile material into new reserves, and we're pioneering that in our Porcupine district in northern Ontario. EcoTails is meant to drive water intensity out of the system. Right now, water is the biggest impediment to development of new mines in the world. If we can lower our water intensity in our tailings facility by effectively dehydrating our tailings, dry stacking them, that will significantly drive down our operating costs and the social risk associated with building new mines, and more readily allow us to get mines permitted and accepted by surrounding communities. We're also pioneering a continuous miner. It's essentially a tunnel boring machine in partnership with Sandvik at our Musselwhite mine. We'll actually get delivery of that later next year. And what that will do is triple the efficiency of our lateral mine development. Right now, we develop about 4 meters a day. We can get up to 12 meters a day with this equipment and significantly drive down our labor intensity. The other thing we're doing on the technology side, and this is a good segue to what Fraser's going to talk about a little later on, is looking downstream in terms of driving friction costs out of the system in delivering our gold into the market. And we've seen with the advent of Bitcoin and blockchain, blockchain is revolutionizing the delivery of financial services by removing the middleman. We see the applicability of blockchain to goods and services generally, where there's significant costs, transaction costs associated with procuring equipment, supplies, and people, and services. And Bitcoin has really cornered the market in terms of the currency to participate in the blockchain. But what we've launched in partnership with TradeWinds is a gold-backed digital currency to participate with Bitcoin to capture that blockchain market. And that's quite exciting because that has the potential not only to give us another platform for distribution of gold, but also drive significant transaction costs out of the system by removing the bullion banks from the middle of the deal. And so that's exciting as well. So I would say, if you'd asked me 2 years ago, do we adopt technology in the mining industry? 2 years ago, I would have told you we make equipment bigger. You know, the average mine grade of gold deposits in the world is about 1 gram per ton. And that's about a third of where it was 20 years ago. And to compensate for that downward decline in grades, we've just made our trucks and shovels bigger. But now, with the advent of new technologies in the marketplace, artificial intelligence, the Internet of Things, which we're rapidly adopting into the mining industry, we see significant potential to drive labor costs out of the system. And within the input cost structure of our industry, 40% of that is represented by labor. That's the low-hanging fruit. And that's what we can deliver in terms of the next step of meaningful cost structure reform within the industry over the ensuing 5 to 10 years. And we're rapidly adopting that technology within our existing portfolio of mines. Beyond 2020, we have 3 large-scale projects: the Century project in Timmins, the Nueva Unión and Norte Abierto projects in Chile, significant mineral endowments. We're bringing them through the feasibility study stage right now. Each of these projects have the potential of contributing 300,000 to 500,000 ounces of gold production growth in the long term, beyond the 3 million ounces that we have in the production profile currently. So we're going to make as strong an investment case as possible while we optimize our existing operations and grow our production profile by about 20%. So that's really all I had at this point, and I guess at this point we'll go into the Q&A session.
Exactly. Well,
thanks very much for your attention.
Thank you very much.